The house hasn't changed much. Same street, same floor plan as the one next door. The people who bought both of them in 2005 made the same down payment, signed the same 30-year loan, drove away with the same key on the same foam keychain. 21 years later, one of them owns it free and clear. The other owes $252,000 and won't be done until 2050. Nothing dramatic separated them. Just one quiet decision made on an ordinary Tuesday that compounded in silence for 2 decades. One decision, 2 directions. The nail is already in the wall when you move in. The previous owner left it there. Just a single finish nail, maybe 2 inches high, slightly off-center on the living room wall. You notice it the first morning, standing in the empty room with a cup of coffee, the moving boxes still stacked by the door. In one version of your life, you hang a family photo on it and move on. The nail does its job. You do yours. You call your bank that afternoon and set up an automatic transfer. $150 extra every month going straight to your mortgage principal. Not because someone told you to, not because you ran the numbers on a spreadsheet, just because it felt like the right thing to do with the small amount left over after the bills. You don't tell anyone. There's nothing to tell. It's a Tuesday. In the other version of your life, you stand in that same living room and feel something hard to name. Not dissatisfaction exactly, more like the gap between what the house is and what it should be. The linoleum in the kitchen catches the afternoon light in a way that bothers you. The layout is almost open concept but not quite. The previous owner's paint colors are still on every wall. This is your home now. It doesn't feel like it yet. By month 2, you've taken out a home equity line of credit, $24,000, and the kitchen is getting gutted. New floors, new cabinets, and an island that opens the whole space up. You stand in the middle of the renovation, and it finally feels like yours. That feeling is real. It costs $24,000 plus interest, and it is real. Both of you are now living in the same house on the same street. Both are paying $1,139 a month on a 30-year mortgage at 5.9%. Both making around $46,000 a year. You're a project coordinator at a logistics company. Your neighbor is a physical therapist at a regional clinic. Neither of you is behind. Neither of you is ahead. The starting line is still perfectly even. Except it isn't. Because one of you just added $24,000 in debt to a house you've owned for 60 days, and one of you just quietly started pulling your payoff date forward, month by month, without a single person noticing or congratulating you for it. That $150 a month is not a dramatic number. It won't make a difference this year. It barely makes a dent in the second year. But a 30-year mortgage at 9% is a machine that runs almost entirely on interest in the early years. In year 1, nearly $900 of your $1,139 monthly payment goes straight to the bank, not to the principal you actually own. The extra $150 changes that math slowly, then all at once. It shortens your loan. It reduces the balance on which interest compounds. It is doing something you won't be able to see clearly for another decade. The HELOC is also doing something you won't see clearly for a while. It adds a second monthly payment on top of the mortgage. It pulls equity out of an asset you just bought and turns it back into debt. And it does something subtler than that. It establishes a pattern. The house becomes a place where the distance between wanting something and borrowing for it is very short. You're not reckless. You're not irresponsible. You made a kitchen look the way a kitchen should look, and you borrowed the money to do it because that's what the equity was there for. That's a completely normal thing to do. Normal is not the same as free. The photo on the nail and the gutted kitchen are both just the beginning. What happens next? The promotion? The better school district 2 zip codes over? The phone call from a realtor who says the timing is right? Is where the first version of your life and the second one stop looking anything like each other. Because the real cost of this house was never going to be the mortgage. It was always going to be what you decided to do the first time someone told you it was time to move up. The friction tax nobody talks about. The call comes in the spring of 2010. It's a realtor. Someone your coworker mentioned at a birthday party. someone who seems to know the neighborhood well and speaks in the confident shorthand of a person who does this every day. The market has been recovering. Your house has appreciated. You got a raise last year, the first real one since before the financial crisis, and your wife just found out she's pregnant with your second. The school district 2 zip codes over has better ratings. The houses there are bigger. And the realtor says, with the easy certainty of someone who has said this 1,000 times, that it's a good window. You think about the kitchen you renovated, the way it finally feels like home. And then you think about the new house, the extra bedroom, the yard with the oak tree out front. You think about your kids growing up there. You say yes. Here is what nobody tells you at the closing table. Every time you sell a home and buy another one, somewhere between 8 and 10% of your property's value simply disappears. Not into the new house, not into your equity. Gone. Agent commissions currently run around 5 to 6% of the sale price. Closing costs, title, insurance, transfer taxes, escrow fees, recording fees, add another 2 to 3% on top of that. On a home worth around $210,000 in 2010, that friction tax lands somewhere between $16,800 and $21,000. That money is gone before you spend a single night in the new house. Think about what 5 years of mortgage payments have built. 5 years of $1,139 a month. 60 payments, just over $68,000 sent to the bank. In the early years of a 30-year mortgage at 5.9%, the majority of each payment goes to interest rather than principal. So the equity you actually built in those 5 years is roughly $14,000 to $16,000. The transaction costs of moving just wiped out nearly everything you accumulated. You walked out of one house and into another and ended up, financially, almost exactly where you started. You didn't make a foolish decision. You made a normal one. That is precisely what makes it so expensive. In the other version of your life, nothing happened that spring. No call from a realtor, no closing table, no wire transfer to a title company. The nail is still in the wall. The linoleum is still on the floor. The $150 extra principal payment went out automatically on the 3rd of the month, the way it has every month for 5 years. Nobody noticed. Nobody congratulated you. You didn't think much about it. But here's what that Tuesday transfer quietly built. Your principal balance is lower than it should be for a loan this age. The interest portion of each payment has been shrinking, slowly, because the balance it's calculated on keeps shrinking. You are ahead of the amortization schedule in a way that doesn't show up anywhere visible. Not on your credit score, not in your bank account, not in a number anyone would ask you about at dinner. It lives in the math, compounding in the background, doing its work without acknowledgement. 2 houses, same street, same starting point. One is 5 years into a reset. The other is 5 years deeper into something that's just beginning to build real momentum. And the version of you that moved is not done moving because the same logic that made the first upgrade feel right, the promotion, the growing family, the better zip code, is still there. It doesn't go away after one move. It gets easier to believe. The HELOC made borrowing feel manageable. The sale made equity feel liquid. The new house made progress feel like something you do by changing addresses, which is exactly the condition you're in when 2020 arrives. Rates fall to levels nobody has ever seen, and the case for starting over one more time starts to sound less like a risk and more like the responsible thing to do. Lower rates, higher debt. The number everyone is talking about in the fall of 2020 is 2.9%. That's the going rate on a 30-year fixed mortgage, the lowest in recorded history. The Federal Reserve has been holding rates near zero since the pandemic hit in March, and the effect on the mortgage market has been extraordinary. Your phone keeps buzzing with headlines. Your brother-in-law refinanced in August and won't stop talking about it. Your financial advisor, a guy named Daniel you've been meaning to call back for 3 months, leaves a voicemail saying this window won't stay open forever. You've been in the second house for 10 years now. The kids are in middle school. The neighborhood is fine, better than fine. But the house feels smaller than it did when you bought it, and you've been watching a development go up about 12 minutes away. Bigger lots, newer construction, the kind of open floor plan you've wanted since you gutted the kitchen in the first house back in 2007. And at 2.9%, the monthly payment on a house that costs $340,000 is actually lower than what you're paying now. You do the math on a mortgage calculator at 11 p.m. on a Wednesday. It works. It more than works. You could pull cash out of your current home's equity, pay off the HELOC balance that's been sitting there since the renovation, cover the down payment on the new place, and still come out with a lower monthly payment than you have today. You call Daniel back the next morning. Here is what the mortgage calculator didn't show you on a Wednesday. Every 30-year mortgage is structured the same way. It front-loads the interest. In the first year of any new 30-year loan, roughly 75 to 80% of each monthly payment goes to interest, not principal. You knew this once. You felt it in the first house, watching the balance barely move in those early years. But 10 years into your second mortgage, that ratio had finally started shifting. You were paying more principal than interest each month for the first time. The loan was genuinely shrinking. The new mortgage resets that ratio back to year one. You are 44 years old. You have just taken out a 30-year mortgage. If you make every payment on schedule and never move again, this loan will be paid off in 2050. You will be 74 years old. The rate went down. The debt went up. And the thing that felt like financial optimization, pulling equity, lowering your payment, locking in a historic rate, was actually the banking system doing what it does best. It made starting over look like a genius move. This is what the industry calls leveraging your equity. What it actually is a very efficient way to stay in debt for the rest of your working life. In the other version, the fall of 2020 is quiet. The 2.9% headlines come through just the same. But the version of you that stayed in the first house runs a different calculation. Your remaining balance is now under $35,000. The $150 extra you've been paying every month for 15 years has done what compound math does when you leave it alone long enough. It has pulled your payoff date forward by years. You are not refinancing. You are not resetting. You are watching the number get smaller every month and doing nothing else. Nothing else is the whole point. Because while the other version of you is celebrating a lower monthly payment, you are 6 or 7 years away from having no payment at all. And what happens when a mortgage disappears? When $1,139 a month stops going to a bank and starts going somewhere else entirely, is the part of this story that most people never get to. That part is coming. But first, you need to see what both versions of this life look like right now. Today, 21 years after that Tuesday in Memphis. Because the number you're about to see, the real gap between staying and leaving, is the number that changes how you think about every house you will ever live in for the rest of your life. The number you can't unsee. It is 2026, 21 years from that Tuesday in Memphis. You are 50 years old. Both versions of you woke up this morning, made coffee, and went to work. From the outside, the two lives look roughly similar. Same age, same general income trajectory, same city. But the financial distance between them, the actual arithmetic distance, is the kind of number that doesn't feel real until you write it down. So, write it down. In one version of your life, your remaining mortgage balance is approximately $18,000. That is what 21 years of $1,139 a month plus $150 extra every single month without missing one has reduced a $190,000 loan to $18,000. You could write that check from your savings account this afternoon and own your home outright before dinner. You don't even have to do that. At your current pace, the mortgage is gone within the next 14 months regardless. Either way, you are standing at the edge of something most Americans never reach, a paid-off house before retirement. When that last payment clears, your monthly housing cost drops to property taxes and insurance. In this market, it runs around $300 a month. The $1,139 that has been leaving your account every month for over 2 decades doesn't disappear. It redirects. You set up an automatic transfer, the same way you set up the $150 extra back in 2005. And now $1,139 goes into a low-cost index fund every month. No drama, no announcement. just a number moving from one place to another on a Tuesday. In the other version of your